We are back with a technical viewpoint of the markets and with Mr. Bruno Estier. He is an independent technical analyst. Welcome to the studio, Mr. Estier.
Good morning, Daniel.
So you are worried about the markets. Why?
Well, I'm worried because I see the breadth of the market in the US deteriorating. One example of it is the small cap. We have here this black line, which is making lower highs and lower lows on a relative strength. That means the ratio of the small cap versus the S&P is also on a downtrend. And we see that this blue line is the moving average 200 days, and we are on the small cap also below that. This is usually not a too good sign. Things are a little bit better for the mid cap, especially in the last weeks, where you have a rebound of the mid cap and a rebound of the relative strength, but still we are below the highs of June.
And how do the large caps look like?
The large cap usually are represented by the Dow Jones. You can use the Dow Jones Transport, which is here on the top part of the channel, which has been moving down very clearly, or the Dow Jones Industrial, which is also being in a range with lower highs and somehow lower lows. And we see that the recent rebound of the transport, a little rebound of the relative strength of the transport versus the Dow Jones, is really not helping too much yet. So here we have to realize that the momentum is relatively neutral to eventually slowing down, and that we have the risk to revisit the lows that we have seen already in February around 17,000, 17,100.
Let's have a look to the Nasdaq. So is it still above the moving average of 200
The
days?
Nasdaq, if we take the large caps, the Nasdaq 100, then of course this here chart shows that we are above the moving average, which is around 4,380. And unfortunately, we notice that the large cap of the Nasdaq are relatively flat on a relative strength versus the S&P 500. That means they are not overcompensating, if you wish, some of the weaknesses that we see elsewhere. And therefore, here we have to focus on the recent spike low in August at 44.36 and the closing low at 43.44, which could be revisited.
So what about the S&P 500?
Of course, most of the public look at the S&P 500. So they notice that the S&P 500 is only 2% away from its high, which seems good news at first sight. But if we look carefully, what we notice is that we have been in this trading range between 2130 and 2050 for now many months, specifically since about April. And we have a momentum which is all the way slowing down already. And if we look closer on the daily charts, then we notice that even during the month of August, we had a spike low at 2050, which almost threatened the previous closing low at 2044. So that reinforces this importance of this 2044 low. Of course, if there is a good news coming out, maybe there is a small rebound like we had last week's. But we have to realize that if we are breaking this 2044 low, as we have been suggesting it could happen during the fall, at the end of the summer and during the fall, then really it could open a decline to 1980. So it's not really a question of if we are going to have a correction, but when.
So that is for the US markets. So do we expect some trouble for the European markets as well?
Yes, we do expect also some troubles. And why? Because recently the relative strength of Euro Stoxx 50 versus the S&P 500 is not showing some sign of strength. It's on the contrary declining. That means it's underperforming. And that means that on our rise that we had in July, we could threaten again the 3370 to 3290 area. And that's the area that really that we need to look at carefully, because below that it opens more downside.
So that's the situation for Europe. Let's have a look to Japan.
Japan was the good outperforming market. That was the good news, and people could say it could hold the whole things. But if we look carefully now, what we noticed in the last 4 or 5 days that we have a kind of a failure to break up above 21,000. And what we do have, in addition, is a weakening of the relative strength. That means suddenly, contrary to what had happened on the since the beginning of the year, the relative strength of Japan is underperforming S&P 500. That means this one could also roll down. And therefore, we need to look at where are the supports recently, around 20,100 or 20,000, which is a round number. These are really the key area. If it's broken, it opens 19,000 relatively rapidly.
Mm-hmm. You were always preferring India to China. How is that situation? Has this point of view changed now?
Well, it's changing a little bit. India was indeed a good outperforming market, and against the S&P 500 it was still rising, except for the last 2 weeks, and things are rolling down as well there. And we noticed here on the ETF of India that we have a trend support which has been tested already 3 times, and now for the 4th time it looks like we are definitively trying to make close below that. That could open a break of 2750 with 2 tops here, makes a so-called double top, and open then a target around 25. That means something like 5% relatively rapidly down. So this is not good news. So probably the people who are around 2750 are going to put some stops there if they are long this market. And China, we are out of China for a little while longer. We noticed that the relative strength since May has been coming down, and we warned about that already. And the relative strength is not bottoming, it's making new lows. So that's no good news. And in addition, around this consolidation that we had since June in kind of a triangle, we are almost have a first close below the support, and that could open a move from 39 to 35. This is also a relatively wide move and no good news.
So the global markets seem to be quite worrying right now. You will be back in 2 weeks and update us on the situation there.
With pleasure.
Thank you very much, Mr. Estier.
You're welcome.
And thanks for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day and see you next time.